owns 800 billion of US debt, which they do, then of course the United States, as the borrower, has to pay interest, which means that you and I and everybody else gets to pay taxes every year that go to Washington, where they don't fund our roads or schools or hospitals. It's money that the United States government collects and sends to Beijing to pay interest on the debt, and the Chinese use to develop the Red Army. Do you understand? All of this has to happen beneath the surface. Because if Americans understood what I just said, they would realize that beneath all the reality is the opposite. That's the reality of the economic of capitalism.
Is the US headed towards a recession? We all know the stock market has reacted very negatively to Trump's tariffs. But as the administration says, stock market is not the economy. In fact, Trump himself recently said that he's not even looking at the stock market, but rather he's following the bond market. And that's exactly why he decided to pull back the tariffs on Wednesday, because the bond yield was rising. In fact, the US 10-year Treasury yield went from 3.9 on April 3rd, a day after Liberation Day announcement, to 4.39 on early Wednesday before the tariff pullback announcement. That's a huge swing, especially in 10-year treasuries. In fact, this rise played a big part as to why President Trump decided to roll back some of the tariffs on pretty much every country except China. But unfortunately, even though the yield was flat after the announcement on Monday, it seems on Thursday it's climbing back up again. As of recording of this video, the yield currently sits as 4.45%. This number is very important and it tells us a lot about the US economy. And this sudden rise in the last few days is exactly why everyone is worried about a recession in the US. So in today's video, let's go over exactly what this number means, how it affects you and me, and how China might be involved in all this. Before moving forward, if you guys can please hit that subscribe button down below to keep up with all the geopolitical news like this one. Let's begin. Starting with, of course, why President Trump decided to roll back the tariffs when bond market was going up.
Bond markets that persuaded you to reverse course?
I was watching the bond market. The bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful. But yeah, I saw last night where people were getting a little queasy. I think everything had. Well, the big move wasn't what I did today. The big move was what I did on Liberation Day. We had Liberation Day in America. We're liberated from all of the horrible deals that were made, all of the horrible trade deals that were made. And I was helped by people just like this, senator, congressman, and friends, right? And we had great help in the Senate. Our Republican senators have been amazing. They stood tall. And likewise in the House. And John...
Historically, rising treasury yields are followed by a recession, and that's exactly what Trump wanted to avoid, and that's why he cut the tariff. But in this case, the yields don't seem to be slowing down. So let's start from the beginning, from the basics. Let's go over how bonds work. We'll use an example for this. Let's just say Uncle Sam needed some money. So the US government is going to issue a bond. Usually whenever a bond is issued, government tells us three important things. First one is the face value. This is the amount that we need to pay the government right now. In this case, $100. The second is the maturity date, and that could be anywhere from 5 years to 10 years to 30 years. So let's say this bond has a maturity date of 10 years. That means after 10 years from today, the government is going to give us back the $100 that we paid them today. And the third important thing is the coupon rate, or I guess the interest rate. And in this case, this is 5%. So every year on this date, government will give us $5 for loaning them the $100. So for 10 years, we get $5, $5, $5 for every single year. Then at the end of the 10 year, we get our $100 back. So these three things will never change over the life of the bond. The face value, the maturity date, and the interest rate that the government is going to pay us. Those won't change. But let's say 1 year from now, I'm in some trouble, right? I need my $100 back, but the government is not going to pay me this. So I go to someone else. Let's say I go to you, and your name is Jake, and I say, hey, what would you give me for this bond? You can take this. You'll get $5 for every single year, and then at the end of the 10-year, the government will pay you back the $100. What can you pay me right now? So then you'll say that government is now issuing new bonds with 6% interest rate, and the bond that I'm offering you only has a 5% interest rate. So that means I need to drop my price to a level so that $5 becomes 6% of the sales price. That means I'll sell this bond for $83. That way whoever is buying it, they'll get 6% return on their money. And then at the maturity date, they still get $100 from the government. Now before someone goes down and comments that this is not accurate, I want to put a disclaimer right here that this is simplified for the video's sake. In reality, things are much more complicated and the deals never happen one-on-one. They just happen online in secondary markets. And usually math is a lot more complicated than this. But for the video's sake, for this video's sake, our explanation's sake, only thing we need to know is the bond prices go up when the yield goes down, and if the bond prices are going down, the yield goes up. So if a lot of people are selling their bonds, yield goes up. And if a lot of people are buying bonds, so the yield goes down. Now, the yield is going up and it continues to keep going up. So let's look at why it's so important. Because as I said earlier, historically, whenever the yield goes up, it's followed by a recession. So that's definitely a worry, and we'll look at the data that hints at recession in just a second. But another worry we have is that a lot of the US debt is maturing in July. In fact, 25% of the US debt is maturing in July. And that's a big issue for the US government if the yields keep going up. Let me explain why that is. You see, many people speculated that Trump's whole plan was to create uncertainty in the market and kinda crash it. So this would force the Fed to cut their rate, and in turn that would lower the Treasury rate, because even though the Fed rate and the market Treasury rate are not completely one-to-one, they are related heavily. So whenever Fed cuts their rate, the Treasury rates will come down. Whenever Fed increases their rate, the Treasury rates will go up. That's not to say that the market doesn't decide what the exact rate is, but it is still heavily influenced by whatever Fed sets their rate at. So Trump was hoping that if Fed cuts their rate before June, when the Treasury has to renew a lot of US debt, refinance a lot of US debt, they could do it at a lower interest rate. That way we have to pay less money for all the debt for the future. Now, as we all know, this is not what happened. Trump put on the tariffs, the market crashed, and usually when the stock market crashes, the yields do go down because everyone's buying a bond, but this time the yields were going up. So many people started speculating that it's the CCP. CCP knows what Trump wants and they're trying to foil his plan. So CCP owns around $800 billion of US debt, and they're dumping it in the market to keep the rates up so Trump doesn't get his wish. In fact, one of the major voices supporting this theory was none other than Elon Musk's brother, Kimball Musk. The only way to apply sense to Trump's trade war is to create massive uncertainty that will force the Fed to lower the rate for when we need to refinance $7 trillion of treasuries by June. China knows this, and by selling treasuries, they create counter pressure for the Fed to keep the rates high. This game only needs to be played by China for 2 months until the end of May, when we need to refinance our debt. Also remember, China is not a democracy and doesn't have free speech. They can control messaging in their country while Trump cannot control it in America. So Trump is playing chicken with the Fed. China knows this and is selling Treasury to try to make sure Trump loses the Fed chicken game and gets trounced by public opinion. The Fed is run by patriots and will do what they can for America, but they are subject to market pressures like everyone else. But this sounds like a good argument until you start looking at the facts. You see, the Chinese yuan is crashing just like the US dollar. People are pulling their money out of China, and that's why the Chinese currency is crashing. And if CCP was selling the treasuries, they would have to use that money to buy something somewhere else, and that would mean that the Chinese yuan would not be crashing. So, I'm not saying that Kimball Morse is not a smart guy. Clearly, he's probably a lot smarter than me. But we also have to realize that he's a multi-billionaire because of his stake in Tesla. And Tesla gets a lot of money from the CCP. So, as the famous late Charlie Munger said, show me the incentive, I'll show you the results. Kimball Musk here is heavily incentivized to make sure US and China don't have a tariff war because it hurts his business directly, it hurts his pockets directly.
The yield on the 10-year, we were wondering if there was a deleveraging issue, and whether or not China is dumping treasuries. Is that what you see right now? Is China dumping treasuries to try to put pressure on this market?
Maria, I think it works against their purposes if they are dumping treasuries, because if they're dumping treasuries, then they have to buy something else. If they sell dollars, then they strengthen their currency. And as I said earlier, they've actually been weakening their currency, which is a loser for everyone.
Right.
And again, when I hear all these stories, that the dollar is no longer going to be the reserve currency. If you end up with the Chinese who are willing to use their currency as a trade tool, that doesn't seem like a very good reserve asset to me.
Yeah.
Now, of course, that's not to say that CCP could not be dumping treasuries. They could be. But then again, the facts right now don't show it, and until CCP data comes out, and we can assume that it's correct data, we would never know. And on top of all this, CCP only holds about 2-3% of the US debt. So they're not a big player. But you know who is a big player when it comes to owning treasuries? American hedge funds. And the same hedge funds likely lost a lot of money when the stocks went down. And a lot of these hedge funds like investing with insane leverage. So when the stocks go down, their brokerages call them up and ask them for more cash. And what's the quickest way to get cash? Is to sell treasuries. So it's way more likely that the hedge funds are the one that are selling treasuries than countries like China or even Japan, because I saw some people blame this on Japan, but we had an official statement from Japan saying they're not selling any treasuries. Now, I want to be clear, all of us are just guessing, but one guess just seems more likely that Americans are selling treasuries because, after all, Americans own 76% of US treasuries, and China owns 2%. It just seems way less likely that China is actually the one selling here, and it's the Chinese selling that's putting the pressure on the Treasury yield. Here we have Treasury Secretary Scott Bessent explaining this whole thing. China is not the one dumping it, and it's likely the hedge funds that are deleveraging.
Maria, I wanted to address, in the meantime, there is one of these, I've seen it very often in my market career. There's one of these deleveraging convulsions that's going on right now in the markets, and I think it's in the fixed income market. There's some very large leverage players who are experiencing losses. They're having to deleverage. I believe that there is nothing systemic about this. I think that it is an uncomfortable but normal deleveraging that's going on in the bond market. And I expect that as we see the leverage come down, the risk managers tapping people on the shoulders, telling them to bring their books down, which is what happens every couple of years as leverage builds up, then the market will calm down.
So now let's talk about recession. Will pulling back all these tariffs that we're doing with every other country except China, will that help avoid a recession? And it seems like that's probably not going to be the case, because we actually got a play-by-play by Wall Street Journal as to what made Trump pull back the tariffs. And one interesting line that stands out to me is the fact that Trump was okay with triggering a recession with all these tariffs, but one thing he wanted to avoid was a depression. And it seemed like we were heading towards a depression, at least to him, and that's why he pulled it back. Another interesting thing in this report is that Trump was actually watching Fox News Business, and he was watching Jamie Dimon interview. Jamie Dimon is the CEO of JP Morgan Chase, one of the biggest banks in the world. And on Wednesday, he went on to Fox News to basically share his thoughts as to what he thinks about the economy, what he thinks about the tariff. And in this interview, he said something that apparently really hit home with Trump. Jamie Dimon said that it's very likely that we're going to have a recession sometimes very soon. And after hearing this, Trump decided to pull back tariffs Wednesday afternoon. So I do wanted to show you guys some clips from this interview because Jamie Dimon is one of the smartest guys in the world, and whatever he thinks about the economy will likely be correct. It will have a better chance of being correct than any of us. So here first, I just wanted to show you guys his thoughts on tariffs against China more specifically. Let's listen.
China and Russia have made it clear they want to kind of dismantle the post-World War II system. And I think the goal of all this trade stuff should be to make Europe and our trading partners, Japan, Korea, Philippines, stronger, not weaker, bring them closer as we build up our military. And any trade that protects military, that we should definitely do. I mean, we made a lot of mistakes about, as you know, pharmaceuticals, shipping, pharmaceutical ingredients, penicillin.
That we're so reliant on China for all of this stuff.
We can't rely on any potential adversary for things we need for our military. And so, there I'm quite sympathetic. That we should do, that's absolutely paramount. So security is economic security, national security are almost directly related in the long run. Hopefully when these wars get resolved, and I hope in the interest of Ukraine, where they have sovereignty when it's over, and the interest of Israel, where not being constantly attacked by terrorists on three sides, you need to keep the economic alliance together. I think it would be in Russia's and North Korea's, Iran's, and China's interest to fragment the Western world. And I think that would be the biggest long-term mistake. And I'm talking about over 30 or 40 years. I don't want to read the book about how the West was lost.
Now this is where we need to talk about the Liberation Day and all the tariffs that Trump introduced. As you guys just heard, it's definitely a good idea to put tariffs on industries that you want to put tariffs against adversaries who are not treating you fairly. But what Trump did was aggressive, to say the least. He put tariff on every single country, pretty much every single country that we trade with, including one country where just penguins live. Now, the markets were not expecting this, and even the people who were expecting some kind of reciprocity in terms of tariffs were not expecting the number, the amount, the percentage of tariff to be this high. In fact, the US tariff after the Liberation Day was one of the highest we have ever had since 1930s, almost 100 years ago. So because of this kind of announcement, it created a lot of uncertainty, and businesses stopped investing money. They canceled new factories, they canceled new plans until they got more clarity. And on top of that, as we already covered, the Treasury rates was going up, and that rate affects a lot of things. It will affect what mortgage you and I can get, it will affect what loans businesses can get. So that meant that businesses didn't know what the future held, and on top of that, if they wanted to do something new, if they wanted to invest money, the loans they would have likely taken would be much more expensive. That meant the businesses slow down, investing slows down, and in turn that means jobs slow down and people have less money to spend. That leads to recession. Here we have Jamie Dimon again explaining that why recession is a likely outcome for the US economy.
Because while all of this is happening, you've got, for example, your economics team predicting a recession this year, and you've got corporations saying, I'm cutting back on spending and investing right now.
Yeah, so normally I don't pay that much attention to anecdotes, but you heard them, they're real. I hear it from just everybody now. Going to cut back a little bit, I'm going to wait, see what happens. That is kind of recessionary talk. So, we've been in this kind of very soft landing for a long time. Consumers have money, they were spending money, corporate is making profits. I do remind people part of that was because of our extraordinary fiscal spending. We borrowed and spent $11 trillion since COVID. And that obviously drives a lot of growth, it drives corporate profits. So I think what we're going to see now is corporations making announcement after announcement about, don't expect my guidance to be true, I'm going to hold back here a little bit. These are long-term decisions they have to make. They may want to see the tax bill, which hopefully they can get done in July. So yeah, I think you're going to see a slowdown. I think the economists are probably right to say that you should expect that.
YouTube just dropped a mind-boggling announcement. It is paying creators $64 million per day. Why? Well, because YouTube doesn't have enough creators right now. That's why you see videos on your homepage that have less than 1,000 views, like this one. Now, of course, that doesn't mean everyone should start a channel. But if you have ever wondered about starting a YouTube channel or a faceless channel, now is the perfect time. YouTube is paying creators millions every single day, and it's pushing newer and smaller channels now more than ever. But I'm sure you have many questions on how to start and grow a channel. I get these questions in my email all the time from some of you guys. That's why we have decided to put all our YouTube advice into one training bootcamp for completely free. So if you're someone interested in starting your own YouTube channel, you can sign up for this bootcamp by clicking the link in the description or scanning the QR code on your screen. This bootcamp is like a Zoom call, so it is limited to 100 people at a time. So be sure to sign up before it gets full. Now back to the video.